Hi, I'm Sebastian Evans and I'm the Chief Investment Officer and Managing Director of NAOS Asset Management. In 2013 we launched our first listed investment company, NCC, as we saw a clear need in the market to provide investors with a listed investment company that provides a pure and concentrated exposure to companies outside the ASX Top 50. Since listing in 2013, NAOS has been able to grow our investor base from 400 investors to today it's now over 8,500 shareholders across our three listed investment companies, being NCC, NAC and NSC. These three listed investment companies operate under the same investment philosophy and process. That is, they have a concentrated portfolio structure, they all focus on industrial companies, and they can all hold 100% cash in times when adequate investment opportunities are not able to be sourced by the investment team. The first step in the NAOS investment process focuses on the management and culture aspects of our investments or any potential investment. When we look at all of our businesses, many of them are often led by the founders of their respective businesses, and ultimately we believe these type of businesses will succeed in the long term and have a clear competitive advantage and deep understanding of the businesses that they operate. In regards to valuation, we believe that valuation should be looked at through a long-term lens. Market participants and investors today often are too focused on the short-term valuation of any business as opposed to what it may be worth in 3 to 5 years' time. The most important aspect of our investment process is margin of safety. This looks at the potential loss we may get in a business, assuming that many of our assumptions prove incorrect or inconsistent. Listed investment companies are also able to pay fully franked dividends, assuming their performance allows them to do this. This is a large competitive advantage compared to the unit trust structure, which can lead to very lumpy distribution profiles as opposed to a smooth distribution profile which hopefully grows over the longer term. And if you do require any further information on the NAOS products or the investment process, don't hesitate to contact any member of the NAOS team. Good morning everyone, my name's Sebastian Evans, as per the video, so I'm sure you better work it out. I'm the Chief Investment Officer and Managing Director of NAOS Asset Management, and thank you for coming to our Roadshow presentation for, I suppose, what is the halfway through of 2018. This is our third Roadshow, so hopefully I should be able to get my act together, seeing this is my third time around this week. In regards to the disclaimer, I will just mention we've changed the presentation slightly this year. We've tried to give a little bit more flavour and a few more numbers in regards to our portfolio. Obviously with a very large disclaimer that this is our own internal forecast and they're not to be relied upon, so please don't rely upon anything in this presentation. Obviously do your own homework before you make any financial decision and seek advice. As per the video, I think it's important because 5.5 years ago almost, we started NCC, our first LIC, and raised the measly amount of about $18 million and had 400 shareholders. Some of those very first shareholders are sitting in this room today. And pleasingly, we've been able to grow that to over 8,000 today and almost $350 million in FUM. Unlike many of our peers, we run 3 LICs, so 99.99% of our funds are all in listed investment companies as opposed to unlisted unit trusts, so we are quite different to many of our peers. I suppose the reason why we are in existence, and I know many of you have seen this slide before, is because we believe in, I suppose, 3 key points, even though there are 8 up there. The first one is we do take a very long-term view. As people probably in the NCC portfolio would understand, and as per the slides that I'll go through, we haven't added or exited one position over the past 12 months. I think if you're invested in any other funds, I think that it'd be pretty hard to see something like that. Many fund managers do churn over their portfolio, always looking for new ideas and exiting other ideas, whereby we try to take quite a long-term view and go along with management, I suppose, for the ride and allow them to execute their strategy over many, many years. You know, running my own business here with my team, you know, we're clearly not yet a success, but we're not a success overnight. You know, it takes many, many years for an investment to come to fruition. And I think if you look at some of the best investments that remain on the stock market, you know, I had a gentleman talk to me about CSL before. If you think how many years that's taken, we're much believer in in backing management teams and proven investment strategies and business strategies, and that's what we try to do here. The other difference is we're very concentrated. So we have 9 to 11 positions in all 3 of our LICs. So we are highly concentrated. We're big believers that, as Ben will go through later on in the presentation, that it pays to have high conviction. a quote that I was listening to the other day by a very well-known gentleman who runs a US funds management firm, recently retired. And he said, the reason why I'm retiring, it's not just an age thing, but in the US, for example, the amount of stocks listed has halved since he started about 20 years ago, yet the amount of fund managers has gone from 400 to about 4,000. So it's probably not the best time to become a fund manager if you're interested. But in saying that, I think it shows you that, especially in Australia, and I think many would agree, that the amount of quality businesses, I would say, listed on the ASX, in my view, has decreased substantially. So I think it makes it very hard not only to find quality businesses that are undervalued, but if you're running 40 or 50 or 80 stocks in a portfolio, I think it's very hard to really show to your investors that those 80 businesses are truly undervalued and are of a higher quality, hence why we run quite a concentrated portfolio structure. Our investment mandate, in my view, is made up of two parts. The first part is, even though we are a micro-cap and small-cap manager, I've learnt the hard way over quite a few years now, that is, everyone remembers your worst months and worst performance. No one remembers your best years and your best months. So the idea is, for our investment team, is that we're here not to lose our shareholders' capital. It is much easier for us to compound higher returns over the longer term if we're minimising those down months, and that's what we set out to do in any investment decision. It's not about how much money we can make, it's about how much are we potentially going to lose, and I think that's very different to a lot of other investment processes out there. The other point is we want to provide people with an exposure, a pure exposure to small cap and micro cap companies. So we're not focused on liquidity because we run closed funds, we don't have redemptions, so we can invest in a business based on its value proposition regardless of size and liquidity, and that is very unique compared to some of our peers. That's hence why some of our businesses, we've got two businesses that are only valued at about $20 to $25 million, so they are very small. But that's the exposure we're trying to give our 8,000 shareholders. This is a new slide, and we're trying to, I suppose, describe it as best we can, the three LICs that we have. I get a lot of phone calls. Everyone rings up some member of the team and say, which LIC, or how are the LICs different, and then B, which one would you buy? And to make it simple, we've split them up there. So the main thing that is similar between all of these three LICs is the investment process is exactly the same. So they all focus on industrials. We don't invest in resource companies. We don't invest in early stage technology companies, which has obviously probably hurt us in the past 6 months. But they all maintain a very long-term focused investment philosophy. The only thing that is different is the size of the companies. So you can see NCC invest in businesses between roughly $20 million to $250 million. NSC, or the Small Cap Opportunities Company, invest in businesses between $100 million to $1 billion. And then NAC, our mid-cap opportunities company, or X50 opportunities company, between 400 million to $1 billion. And the reason why we use size, and I think it's interesting, we don't use benchmarks, is, and I've said this a number of times before, when everyone talks about the ASX 200 and they say the ASX 200 was up, 1% today, it's not based on the size of the companies, it's based on the liquidity of the companies. As I've said time and time again, Reece is an example. The plumbing business, it's valued at, off the top of my head, it'd have to be many billions of dollars, say $6 or $7 billion, but it's not in the ASX 200. And it's not on the ASX 200 because the Wilson family still has such a large shareholding in that business. So in my view, it makes it a very high quality business, even though it's not in the ASX 200. So I'd be a little bit wary. Often the stocks that get in the ASX 200s, especially those smaller ones, they tend to be much more liquid businesses that have, risen very quickly to stardom, I suppose. But that doesn't necessarily mean it makes them a good business. Performance, probably the most important slide, I'm sure, for many in the presentation, and it's been no secret that obviously the past 6 months has been a challenge for NAOS across probably all three of our products, and we definitely don't shy away from that. As I suppose some in the room would notice, we've obviously gone through reporting season in August. These numbers don't reflect that, but many of you would probably understand, knowing some of our core holdings, we've probably had a much better reporting season than we have had over the previous 6 months, which is pleasing. In saying that, I think when you look at the year as a whole, I suppose I look at the financial year, and the way I can best describe it is, if you look at NAC and NCC, because we've been running those for 12 months, respectively, they did about 12% returns to December, 31st of December. NAC then had a full year return of about, I think it was off the top of my head, about 12%. and NCC had about a 7% return. So you can clearly see we found the second half of the year much more challenging than we did the first half. To make matters supremely worse was that our benchmark then rallied much harder through the second half of the year. So to put that in context, the Small Ordinaries Resources Index was up 50% for the financial year alone. And then when you overlay a few technology companies, I'm sure everyone thinks of the Afterpays of the world. That sort of rubs salt into the wounds a little bit, and clearly it was more of a challenging year for NAOS as a whole. What I would say though is if you look at our longer term numbers, they're still very much in the ballpark of 15%. We'd like to aim for 20% as that's our high hurdle, but even with the year that we've had, we're still able to maintain a fairly good long-term performance. And NAC and NCC now still are yet to produce a negative financial year or calendar year return. In regards to the NTA and the share price, obviously NCC trades at a premium, which is pleasing. NAC trades at a smaller discount, which obviously we've been working on now for a number of years because it did trade at a premium. And then NSC, which is obviously the new LIC, which we inherited about 7 months ago. I'm sure many in here I was a bit worried when the stock was 76 cents about a month ago. But pleasingly, it's now rallied even after the dividend close to about 85 cents, I think, this morning. So it's closing in on its NTA. And, we've been working very, very hard internally on that. And we don't see, due to its liquidity profile, while it may not be it could very well be close to NTA, hopefully, by the end of the year if we continue with our marketing effort. But obviously, hopefully, the performance picks up as well. I won't go through all the quotes. We've tried to minimise the quotes a little bit this time around, so I'll let you read them in your own time. But I'll quickly go into 2 of the 3 funds, and I'll let Ben touch on NAC at the end. In regards to NCC, the first slide looks at the dividend profile. A reasonably basic slide, but I think with our results, it was pleasing. Even with the year that we had, we were able to grow the dividend yield once again. So that's the 6th year of dividend growth that we've had since we've listed, which I can tell you is no mean feat when you run a listed investment company. It's not the easiest thing in the world to do. What we've been able to give you there also is some transparency on our profit reserves. So you can see that figure there represents, give or take, 1.5 to 2 years of dividend payments. So if we're able to, or we're not able to produce any performance going forward, hopefully that's not the case, we're still able to maintain that dividend payment going forward for 2 years. So it gives you some comfort that the board's very much focused on not just paying out the biggest dividends possible, but keeping some away so we're able to smooth out the dividend profile, which I think is quite key to this product, especially when you run your investments. We don't have the high liquidity portfolio that allows us to pay big dividends and liquidate the fund and then go again. So it's perfect for what we're trying to do in regards to NCC. This is a new slide that we've put in regards to the portfolio metrics. So everyone tends to ask, well, what are the nine holdings across all the funds, or 10 holdings, or 11 holdings? And as you'd be aware, we don't release the holdings. We tend to give quite a lot of disclosure into what they are throughout the year, so I'm sure you wouldn't have to be a rocket scientist to work it out. But what some people have asked is to give us a bit of flavour in regards to the valuation of the portfolio, and that's what we try to do on the right-hand side. In regards to the fund itself and the portfolio structure, there's 9 holdings. There were no changes throughout the year, which I believe is a reasonable thing. The only reason you tend to get out of a business is due to a valuation, so a full valuation, or you get out because obviously there's a significant issue in regards to management's credibility and consistency. And obviously that hasn't happened yet, obviously through financial year 18. The directors continue to have a very large holding in the LIC, so I don't have any shares. I don't hold any shares outside of the 3 LICs, so I'm very aligned, and the rest of my directors are also very aligned with all of our shareholders. And the average market cap's about 90 million, so they are very small businesses, and we don't shy away from that. They are very much micro cap or even nano cap businesses. If you look at the portfolio metrics, and this is our own internal data that we've issued here, is the average dividend yield in that portfolio is about 2.35%. So everyone says, well, they're $90 million companies, they probably don't pay a dividend. That's not quite right. So about half the portfolio pays a dividend and half doesn't. We often find these earlier businesses, they tend not to pay a dividend, but as the business generates scale, then they do pay a dividend because they go through a business life cycle. The projected EBITDA growth, so this is the earnings growth we're expecting in the portfolio, is roughly 27%. you would expect it to be a high figure because these are very small businesses, and it's a law of numbers. You know, the example I'll give is many of you would know we invest in an exporting business that exports hay and red meat. They made $1 million last year. This is Wingara. They've given guidance this year that they're expecting to make $6 million. So when you get percentage increases like that, it does throw your portfolio out a bit. So we've tried to normalise it a little bit for you. But even so, we're expecting 27% earnings growth. When you look at the valuation of the portfolio, we're paying about 7 times earnings pre-tax and pre-depreciation for that portfolio. So that's what we do day in, day out. You're looking at growth versus value, and you're trying to find the equation of, well, how does that look like? What does that look like going forward? And then hopefully over time that should generate a return for shareholders, and that's what we do. If you look at the net debt to EBITDA figure, as I've always said to many of our shareholders, even though we run a concentrated fund, we do focus on the balance sheets. So the portfolio is very under-geared in our view. If you were to take out one position, that figure would probably be negative. So most of the businesses we invest in have net cash balance sheets. For example, we don't tend to invest in highly geared businesses because we believe that's unsustainable, and they're reliant not only on the banks but also equity markets, which, as you can see, when the GFC, that can change at a rate of knots and often leave you with very few choices. Two businesses I'll just quickly touch on, and NCC was a little harder to touch on because there hasn't been any change throughout the year. But obviously a very topical business is Wingara, as I mentioned before. I'm sure some people have probably seen the articles floating around in the newspapers in regards to a shortage of hay floating around Australia in certain parts. But Wingara was a business that only listed about 2 years ago. Its founder has a lot of experience in regards to commodities trading and exporting out of Australia. And he actually acquired this business, he and his wife acquired this business about 4 years ago as an unlisted business and then listed it 2 years ago. It's very small. As I said, it's only capped at about $25 million. Pleasingly though, over the journey, they've been able to prove that the model does work. And it's really based on the thematic that, you know, many countries view Australia as the food bowl to the world. High quality products that are being exported to many Asian countries. So the biggest customers for Wingara are Taiwan, South Korea, China, Japan, places where they don't have the scale or the land mass to produce these products. But I think what a lot of people don't understand is it's very well and good to provide a product or a high quality product to these customers, but because of their scale and size, some of these countries, they need it frequently and consistently, and that's the big difference, we believe, from Wingara to some of its peers, and that's what they're focusing on. That's why they acquired an exporting business in regards to red meat. So it's a blast freezing business whereby you'll be able to export lamb products and things like that. Pleasingly, they provided their first set of guidance ever as a listed company a few weeks ago, and we think it really shows that the model is working, and hopefully over time they can start to spread out potentially into other commodities as well. The second one there is Enero Group. It's been a business that's been in the portfolio since day one, so it has been a very long time coming. But pleasingly, that business did produce an excellent set of financial results in August. So what they do is they're an advertising company. So if anyone shops at Aldi here and you see the TV ads, Enero does all those TV ads. They also work with some of the largest IT companies and tech companies in the world. One of their businesses got voted the best tech PR company globally. So they're based in London and also in New York. So we believe that's another great thematic play whereby this was very much a turnaround company. It's a people business. Anyone who runs a people business here in this room understands they're probably some of the hardest businesses to run, especially when you're dealing with probably 700 people under the age of 29. But pleasingly, after 5 years, they've really been able to get it together. They've really been a focus on some of their largest clients. They do a lot of work with the state government now and also the federal government. And once you get these businesses, I suppose the motivation's high and confidence is high, they really start to hum. And we think based on their results in the second half, they're really shaping up for an excellent FY19 as well. Obviously, just a little quote there in regards to capital preservation. I know it's a little bit hard to lose sight. You can always tell when people lose sight because everyone starts looking at everyone else's performance numbers and seeing how high they are. But as I can remember in 07 and 08, it does change very quickly. So we try not to lose sight of that, even though can be hard when you do go through bull markets like we are now. Just to provide a little bit more clarity on our performance, this chart here looks at our performance both up and down relative to the index. The reason why we show you this is investors love volatility to the upside. If the market's up 20% and you're up 20% or 30%, then they love you. If the market falls 10% and you're down 15%, they don't want to talk to you. And so what we try to focus on as a funds management firm is you want to minimise those down months. So your volatility in the down months is key. And we try to illustrate this by showing that NCC in this case, only on a few months, when you look at those large drawdowns on the index, which is the blue line, sorry, the orange line, you can see that the blue line has very rarely underperformed against that respective benchmark move. Obviously, if you're a little bit more cynical, you'll say more recently it has, and yes, that is the case. I would also say that you've clearly seen a rotation in equity benchmarks into resources and tech, which is obviously not where we play, but earlier on it was a different story when you can see the volatility in the market was much higher. 12 months or 24 months ago, we were much better at preserving capital, but also performing. Obviously, as this data set gets longer, it gives you a much better idea of how we do, I suppose, preserve capital. And this is almost a 6-year data set, so it is quite significant. NSC is probably the more topical one. Obviously, we've only had this LIC now it's coming up to about 8 months, I think. And clearly hasn't been, it's been quite not a tough journey, but, very much a large piece of work that we've been trying to get to as an investment team. The topical point of the dividend yield, obviously we inherited a fixed dividend policy at that time, so I think it was about 5.5% or 6%, 50% franked. And as a board, we changed that to more link with our other LICs to provide a growing stream of fully franked dividends. So obviously we reset that dividend at 2.5 cents in the half, and then we've announced a 3 cent fully franked dividend in the second half. So it provides about 5.5 cents fully franked for all of those shareholders. The other two key points I would say is obviously the profit reserve account there, as you can see there, provides for about 1.5 years of dividend coverage, which when you consider we virtually had no performance over the past 6 months, that's not a bad place to be in. The franking balance is also very strong in this LIC as well, so it does give us a bit more comfort around that. The final point I would mention is obviously the DRP. For anyone who invests through the DRP, this doesn't issue any shares. It actually buys shares on market. So for everyone who's selling shares at a discount to NTA, that will buy the shares off them and then distribute it to people who wish to own them at a discount to NTA. So it eliminates any dilution. In regards to the metrics of the portfolio, many of you would know we inherited about 81 stocks about 8 months ago. To put it in context, we sold 80 of those stocks and kept 1, and we've added 10. So we've left ourselves with 11 positions, 10 of which are different from 12 months ago, which is no easy feat, especially in a market where we are today where things are quite buoyant. So you're really struggling to find value a little bit. The cash weighting is about 7.6%, but it would actually be quite a bit higher if you looked at some of the businesses. So one business, for example, we invest in a company, the code is TOT. It's a $100 million cash box that does very short-term lending for commercial developments. Obviously, because the banks are pulling back, people and are unable to get credit as easily, and they provide short-term loans. So in my view, I would treat that as a cash box, but we haven't treated it in that figure. So the look-through cash position would be much higher. Pleasingly, the NSC directors have been continuing to acquire shares. Anyone who follows the ASX would see I acquired some more shares a couple of weeks ago as well. And the average market cap's about 230 million, so about double the size of what NCC is, or almost 2.5 times. If you look at the portfolio metrics, the dividend yield's a bit higher, which you'd expect because they're larger stocks, probably slightly more mature businesses. The growth's a bit lower, but still reasonably high, running at about 20%. And the value, I suppose the valuation multiple's 8 times, so a little bit higher again, as you'd expect because they're bigger businesses. But we still think 8 times relative to the 20% growth is not a bad place to be, assuming that 20% does eventuate, which, as many would know, it's a very rubbery figure. Obviously, some will do better than that, and unfortunately, I'm sure I'll be here in 12 months' time, and some will do much worse than that figure. But if you look at the net debt to EBITDA figure, it's very low as well. So it's a conservative portfolio that we think can grow, but it does provide a very good level of, I suppose, valuation support. And I do get asked a lot, are you a value or a growth manager? And I think, the most important thing to say is everyone in this room invests in a business because they believe it's going to grow, but it doesn't make you a growth manager. You have an element of valuation behind you. So we like to buy fairly valued or good businesses that are undervalued, but we do believe they are going to grow over the longer term, and that's what we try to do. Two key holdings in that fund, as many of you would know. The first one is Over the Wire, which I would guess not many of you would know in this room. It'd be a fair guess. So started as a business, was only valued at about $5 million about seven years ago, and today it's valued at about $200 million. They provide data security, telecommunication services to small to medium businesses. I can happily say we moved to them about 3 months ago, and we've been reasonably happy with the move. But it's a very real problem for a lot of small to medium businesses. If you're looking to get yourself a data security network or some form of security, you want an all-in-one offering, it is not that easy to do. I'm sure many will go to Telstra and they find that customer service is almost non-existent, and that's provided a very big opportunity for the likes of Over the Wire. You would have also seen that they've provided a 20% organic growth figure for this year, and they've called it out for next year. And pleasingly, the stock was up almost 30% in August post their result. M&F Group, many of you would know, is our largest holding in the NSC portfolio, and one we've followed for many years. Sold out a couple of years ago and then bought back in when the shares fell reasonably sharply. Like Over the Wire, led by their founders still. The founders still own about 35% of this business. It was started basically in a small data cupboard many years ago, and today deals with some of the largest companies in the world, tech companies of the world, so your Twilios, even companies like Google, for example. So I always give the example that, if you use Skype in this room and you're calling someone from your laptop to your mobile, Skype actually pays M&F for that phone number and some of that software. Yet very few people would actually have ever heard of M&F Group. And the reason why you haven't heard of it is because many of these entrepreneurs are very poor at marketing their business, and that'd probably be an understatement. But we think it's a very good business. They grew their software engineers, for example, from 80 to 120, and they're all based down in Melbourne or down in George Street. It's a very good R&D business that expenses a lot of their R&D, one we think that can continue to grow organically for many years. I'll now get Ben to touch on NAC and also our thoughts on concentrating investing.
Thanks, Sebastian. So just touching on NAC firstly, firstly the dividend. You can see there that over the life of NAC, we've been able to maintain that fully franked growing stream of dividends. And that's really our aim. Sebastian mentioned earlier, rather than paying out a percentage of profits, which can vary wildly from year to year, we'd rather have a more sustainable, consistent dividend so that you as the shareholders and owners of NAC have some sort of comfort around what your level of income will be. The second point probably to add to that as well is that recently we've announced a change to the NAC dividend policy where we'll be paying it quarterly. So the level of dividend or the growing level of dividends, our view on that hasn't changed at all. It's rather just to give you a more consistent form of income when buying NAC. The top left corner there, you can see we've got $5.7 million in profit reserves. That covers the next about 1.5 years worth of dividends. So it helps to give you some comfort by putting that figure there that, if we do have a year which is below par or below performance, we still will be able to pay that dividend going forward. Currently where the share price sits, that dividend yield is about 5.25%, and then obviously you can gross that up for the franking credits as well. Turning to the portfolio, so there's 12 holdings in there at the moment. So Sebastian mentioned before, we like to be concentrated, and I will talk a little bit further about why we like to have a concentrated portfolio. The cash weighting there is about 6.5%. That represents a pretty true reflection. A lot of the companies that we invest in, Sebastian mentioned this earlier, tend to have net cash balance sheets, and the point on the bottom right hand of that screen there, we just outline what the net debt to EBITDA of the portfolio looks like of the companies we're invested in. There's certainly, markets can obviously gyrate quite wildly, and so certainly can too economic cycles, but if a company has a decent level of cash on the balance sheet and a strong balance sheet to weather those cycles, it can come out of the other side a much stronger company that it went in. we put up there just the amount of shares that the NAOS directors own. I think that's a very important point when choosing a fund manager. It's the first question that we ask a company when we're investing in it: how much do management own of this business? Because in our experience, a management team who has a significant amount of their own money on the line will make a very different decision to a management team that doesn't. And we'd much prefer to back the team that puts their money where their mouth is, and we certainly believe that at NAOS, and you can see that's reflected in our personal holdings of the LICs. The average market cap's just under 900 million, and the dividend yield about 3.24%. One question to probably ask yourselves there is, how can NAC pay a dividend of 5.5% when the underlying dividend stream of the companies is only a little over 3%? The answer to that is when we sell out of a position and we've made a profit on it, we pay tax on that, and obviously the franking credits are generated from not only that way but also passing on the dividends through to you as the shareholders as well. The EBITDA growth is about 20%, and the valuation we're paying for that, it's about 9 times EV to EBITDA. To put that into context, the wider index that we're operating in, the EV to EBITDA ratio is closer to 20 times. And the growth is sub 5%. So really that's the crux of what we're trying to do, is find companies that we think can generate an outsized level of growth and pay a valuation level which we think represents a fair value in return for the risk that we're taking on. This is the same slide that Sebastian produced before on NCC, and it really just goes to show the capital preservation that our portfolios, or we feel our portfolios, can generate over the course of the long term. So the red line there will show what the index has done on any given month, which as you can see is quite volatile. On those months where the index has fallen quite a bit, we've been able to maintain a capital preservation level where our portfolio hasn't fallen anywhere near as much. And I think if over the longer term, I think this is really the way that fund managers should be measured, because if you can preserve capital in times when the market is falling, and it happens at times that really we can't predict, or I don't really think anyone can predict, then really going forward, it makes your ability to compound that capital much easier. If you lose 100%, or if you lose 50% in any given year, you need to make 100% just to get that back, just to get back to square where you were beforehand. So really capital preservation is something that we think first and foremost when entering an investment position. So having a look at some of the portfolio stocks that we own, Elders on the far left there has been one that over the last 18 months have been quite public insofar as NAOS having an ownership position. Elders is a fantastic company, it hasn't always been that way. We owned it for about 18 months and it did fantastically well across that period of time. The reason that we've sold it is Elders now, it's gone from, so Mark Allison, the managing director, and his management team have done a fantastic job of transforming Elders from an over-leveraged conglomerate into a pure-play agricultural services business. Now, the problem with a services business is that if your customers aren't doing well, then it's very difficult for you to do well as a company. And unfortunately for Elders, despite the internal initiatives that they've taken, it's no secret to anyone in this room, we are going through a pretty significant drought at the moment. So I do think that potentially over the next 12 or 6 to 12 months, Elders' share price may suffer. So I think for the time being, it's probably prudent for us to sit on the sidelines and take a wait-and-see approach. It's still a company that we engage with very actively, and I do think it's reasonable to assume that going forward in the future, we may have a position in Elders again, but for the time being, we've left it out of the portfolio. Hello World is probably a new addition to NAC, which is probably added in the last 6 months. They're a travel agency services business which do leisure travel, accommodation bookings and corporate travel as well. It's the old Harvey World Travel, which was a very broken business model, and back in late 2015, a guy called Andrew Burns vended his travel business AOT into the listed Hello World business, and then he implemented a cost savings program and a more streamlined view of how the company should look and what the growth objectives for the company should look like going forward. The share price has done very well over the course of that 2.5-year period, which unfortunately we haven't been able to participate in a lot of. And the reason that we haven't is because typically when a company goes into a turnaround program, often the company won't actually turn around. It's much more difficult to improve a broken business than what is sometimes perceived to be at the beginning. So the way that we operate, and this was certainly the case with Elders and has been the case with Hello World as well, we'd rather watch the company go through its turnaround process and become a more mature stage where we have confidence that the earnings profile going forward is something that we can reliably estimate, and that's certainly the case with Hello World. It trades at a significant discount to Flight Centre and Corporate Travel, its two listed competitors, despite having a lot of the same sort of competitive qualities as those two businesses. Reece is a company that we've also owned beforehand, and we've recently re-added it to the portfolio. I think Reece is one of the highest quality businesses listed on the Australian stock market. It listed in 1978, and over the course of that 40-year period, the share price alone has compounded returns at 15% every single year on average for 40 years. I don't think there's any other company that I could name that has had such an exemplary track record over such a long period of time. If you add the dividends to that and reinvested those, your return's up closer to 18 or 19%. The management team own about 70% of the company. They're in quite a boring industrial business, but they've proven that with great quality management and great competitive dynamics, that a business like Reece can outperform significantly over the course of time. While we've re-added the position, they recently announced an acquisition of a company in the US called Morsco, which is essentially a Reece lookalike, although it's operating in a much larger country, should I say. The EBITDA margins of Morsco, the business that they've bought, are about 6%. And if you compare that to Reece, Reece has about 14%. So of a company that size, if you can generate, certainly maybe not to 14%, the level that Reece is operating at, but certainly 200 basis points in margin expansion of a company that size makes a huge difference to the underlying earnings profile. And we do think that the Reece management team, given their track record of successfully growing Reece, can do the same thing with a very similar business in a different country. So we talked before about concentrated investing, and Warren Buffett's obviously been quite vocal on how he feels about this. I think he made a comment recently that if he was running $100 million, he'd only have 3 or 4 stocks in his portfolio. We don't think we're Warren Buffett, so we probably won't take it to that level of concentration, but we do think it's something which we believe can drive out-term long performance in a portfolio. And I've just got a couple of slides up here to show you why we believe that's the case. So firstly, just stacking ourselves against some of the other listed investment companies out there. You can see the top one there, they have about 92 holdings in their portfolio, and the bottom 3 lines are the NAOS portfolio. So we tend to have about 10 to 15 stocks in each. And the reason we do that is because we believe that coming across fantastic businesses is very, very hard to do, and good ideas are scarce. What I've shown here is over the last 3 years, there's been 4 stocks in the ASX 300 Industrials Index which have been able to earn an annualised return of over 100%. There's 15 stocks that have earned over a 50% annualised return. So if you look on to the right-hand side there's 219 stocks in that index. Now, how you can tell me that 100 of those are high quality, I do not know. I mean, some people obviously believe that's the case, but we certainly don't. To come across a very high quality business isn't all that easy. For the record, NAOS owns 2 of those businesses currently, and I think we've owned 4 in the past. To put some further data around that, here's 2 theoretical stock portfolios. The one on the left-hand side has 10 stocks in it, all of an equal weighting of 10%, and the one on the right-hand side has 100 stocks in it, all of an equal weighting of 1%. Now, if we have a business that where the share price doubles, on the left-hand side that adds 10% to your return, so it's a meaningful contribution to your overall return. Whereas on the right-hand side, if you get a stock that doubles in 100 stock portfolio, it doesn't really make that much of a difference. Now, the first question you'll probably ask yourself is, well, that's great, but what happens if a stock goes the other way and falls to 0? You're going to lose 10%. There's certain things we do to mitigate that risk. The first is making sure the company has a very strong balance sheet. So if a company is liquid enough to get through any economic cycle, then it usually will come out the other side and the stock won't go to 0. The other things we look to are things that management alignment. Obviously, a management company that has a significant stake in their business has confidence that their business can grow over the longer term. We like to invest in businesses that we understand, where we think we can reliably estimate what the future earnings profile will look like. And finally, we make sure that the position sizing we have in the business is such that we're invested alongside management. Often you'll find in a lot of these businesses they can appear to be illiquid, but if we're investing alongside a management team with a huge amount of skin in the game, it obviously reduces our risk from where we view the position. This piece of research was done by a macro group in the US. Basically, it shows that white horizontal line there shows your market risk, and that black line there shows the portfolio risk. And you can see the portfolio risk reducing with the number of stocks in a portfolio. This piece of research was done by a group called Dresdner Kleinwort, who found that most of your market risk, or 93% of the stock-specific risk, is the market risk is eliminated with a 20-stock portfolio. But you can actually see there that most of the risk is actually reduced around the 10 to 15 stock level. So it doesn't necessarily prove that having 100 stocks in your portfolio correlates to that much less risk as opposed to what the market is doing. Really, it comes down to around that 10 or 15 level, which we certainly abide by with our views and take that view in terms of running our portfolios. So with that, I'll hand back to Sebastian just to run through a bit of a market review, and then the two of us will answer some questions at the end.
So obviously, as Ben said, we're here to obviously pick 9 to 15 stocks across 3 portfolios, and as many of you would know, I'm not a huge fan of talking about the market or the economic outlook, but I'll give it my best shot as I know it is topical. The way I've done it is, I suppose, the way we look at markets, and I did steal this off a very well-known US fund manager who applied it to the US economy and the US market, is there's really 5 key points why there is a market correction or markets do fall significantly in a short period of time. The first point that was brought up is obviously valuation. In my view, obviously valuation can be somewhat subjective, but when you look at some of those larger businesses, it is very factual. And you can see when you're looking at the industrial, so if you strip out your BHPs and your Rios and the banks and things like that, you can still see the industrial type companies, or the larger ones in Australia, are relatively fully valued. So they're trading at 21 times earnings with very little EPS growth, so 2% EPS growth. On any measure, that would be a fairly fully valued business. The one thing that is different from now compared to the GFC, though, in my view, is a lot of these businesses are entering this financial year in a much healthier financial position. They're not geared. They probably have a fair amount of fixed assets, and they're quite liquid in nature. They're not highly geared with lots of intangibles and things like that. So from a balance sheet point of view, they enter the year quite strong. But from a valuation perspective, it is fair to say that they are fairly fully valued, albeit not overvalued. The second one is obviously a recession. So obviously domestically, I'll focus domestically before I turn to the US. But there's been lots of talk about obviously inflation or the lack thereof. I think if you strip out certain pieces of data, the inflation in Australia is relatively low. And everyone obviously is talking about wage growth or the lack thereof. We are seeing though that is starting to change in our view. I think we've seen 150 businesses probably over the last 5 or 6 weeks. And the key point that came across in regards to wage inflation was if you're a civil engineer, for example, or a contractor with civil experience, you're in high demand. And I was looking at I'm sure everyone's looking at the George Street on the tram line there, or the tram line that's yet to be built. People like that working on those projects are in high demand. I didn't realise this, but if you look at Melbourne, for example, they're going to take over Sydney in regards to the amount of dollars they're spending on infrastructure over the next 48 months. There is a lot of work around in regards to infrastructure. Technology is the same. You look at NBN's out there hiring. A lot of software companies that are now based in Sydney are hiring, looking for software engineers, technical sort of based people. They're in very high demand as well. There are obviously pockets where people with certain experience and qualifications probably aren't, but overall you are seeing pockets of people are getting wage rises and increases, albeit it's probably not as obvious as what that chart is showing you on the right there. In regards to confidence, and I feel like I've been saying this for years now, is obviously the chart will tell you to one thing in regards to conditions and confidence levels for small business and business in general. What we would say is it's really been more of the same. Businesses come through, how do you feel about the next 6 months? It feels reasonable. There's enough clarity to give them confidence, but there's not enough work around, and I suppose control over that work to say, well, it's going to be a knockout year. It feels like a grind, but it feels like a manageable grind, if that makes sense. And to be honest, it feels like it's been that way for the past 4 or 5 years. especially in industrial type businesses. And I don't think that's not changing anytime soon, in my view. I think obviously there are pockets in regards to retail, tech, resources we don't look at. Obviously it's clearly very different and very probably company specific and industry specific. But from an industrial point of view, it's reasonable. And I think a great example is, as we said, we invest in an advertising and a PR business. They feel pretty good. When advertising and PR businesses feel pretty good, things aren't too bad because people are spending on marketing, brand awareness, new customer origination and things like that. So overall, we'd say it's not too bad at all, obviously, but not shooting the lights out. Central banks, without putting too many people to sleep, I'll make it as quick as I can. Obviously, the big ones are interest rates. And I think you can talk about this in two ways. The first way is just what central banks are doing. So central banks in Australia are doing nothing, as they've been doing now for the past couple of years. But as we've seen lately, we had a property business in the other day. They mentioned a bank, one of the big four banks. Even if you're a personal investor or even a business, mainly business, they won't lend now on an LVR higher than 50% in regards to property. We've invested in a lending business for that commercial side. I personally think the credit crunch in Australia is quite real. In regards to the Royal Commission and things like that, the banks are very much under pressure. They've got centralised systems now. Every loan goes to the same sort of centralised unit, whereby before they had a little bit more autonomy to do what they wanted to do. And I think that's the issue I see with that is, well, if you're a small business and you rely on credit for certain things to manage your working capital or to expand or whatever it is, well, that credit's not there anymore. And if it is, it's not there in the same quantity. And I think that does play as a bit of an issue on the Australian economy. And that's why you're seeing more and more people enter that sort of non-bank lending space. Obviously, KKR, probably the largest private equity firm in the world. They bought a business called Pepper. They're expanding very aggressively. I know another PE firm's also done the same. That non-bank lending space is really booming. And in our view, especially the way the banks are reacting, we don't see that changing anytime soon. The issue is the banks are such a big part of that market. It's hard for the non-bank lenders to probably match what's coming out. But in my view, it really does need to change, because if credit does continue to tighten at the rate it is tightening, I think it will place some small businesses under a lot of pressure and will pull back expansion and projects and things like that. Investor exuberance. Very few people I've seen, unless you've owned a couple of stocks, I'm not seeing any irrational exuberance. You talk to fund managers, how are they doing? They all tell you the same thing. We're doing, it's all right. It's not too bad. They've been saying the same thing for years. It's not like what it was in 07. I remember when I started in 06, 07, I used the example, you could fall over some iron ore and your stock would be up 1,000%. Everyone was talking about peak oil. Obviously the tech boom, I think that's probably a little bit different. Some technology stocks are probably being valued on very high multiples and the assumption of growth into perpetuity. I think that is quite real. But overall, we're not seeing a lot of irrational exuberance from an investor point of view. Margin lending, things like that. It's not like what it was. Albeit, the other thing that probably does come to mind is, people are pretty conservative as well, investors in general. People seem to have cash on the sideline. If I went around the room and say, you're looking to buy the next dip, so everyone's saying, oh, I'm looking to buy the next dip. And the problem is everyone's waiting to buy the next dip. The dip might not happen. And that's what it sort of feels like. I'm not saying there's value out there, but I think everyone's running from the same sort of conservative point of view. And I think, especially in reporting season in regards to some stocks, it was almost like some funds and investors just capitulated and said, well, I've just got to buy it because it's going up. I've been conservative for so long. So it doesn't feel like we're anywhere near, in my view anyway, in regards to irrational exuberance in the Australian market anyway. The final point, geopolitical events. I probably can't help you. You read the same newspapers that I do. They're probably, a fairly real topic. I know in Australia it's real from the sense of view. I know people talk about franking credits, the change in capital gains tax, negative gearing, Labor government, new Prime Minister every few months. It does create uncertainty, and what does kill bull markets and equity markets in general is uncertainty. If people don't know what they're talking about and they can't predict the future or feel like they're predicting the future, they won't buy equities. That'll be the first thing they probably get rid of. So it is real. Donald Trump, obviously, in regards to uncertainty there, free trade agreements, it does create uncertainty and it does hurt equity markets, albeit you can't put a valuation on it. But it is definitely one to watch and probably the most real problem out of all of those five. Just to finish off on a slightly softer point, as we said 6 months ago for the first time, NAOS, the manager, so our company, not the ones obviously you're invested in, we've started to donate 1% of all of our recurring income to charities. You'd see there we've added, we support bush heritage with a golden-shouldered parrot, which I noticed there was an article in the SMH the other day saying their habitat once again is under threat through deforestation. Greening Australia, obviously in regards to the coral reef, the Great Barrier Reef, and then obviously a new one we've added, which we were down there yesterday, I think it was yesterday, was the Royal Flying Doctor Service, the Central Division. So we've now joined with them as a corporate sponsor for the next few years. In our view, it's a great cause, and we sent out one of our dear colleagues here through the outback for 7 days in a 1950s Falcon. Scott, wherever he is, he was a bit sore and sorry afterwards, but it is very much for a good cause, and hopefully we'd like to add to this list over time as NAOS grows as well. Just to finish off, I always put this in, makes me feel good. You don't need to be the brightest person in the room, you've just got to stay ahead on average over the longer term, and I think that's the way we treat our portfolio. We're not going to get everything right, but over time, if you do get a few right, and I've learned if you can let your winners grow especially, over the longer term, we aim to be in that top quartile of performance, but it all comes down to not losing capital when things are tough, and obviously letting your winners go and sticking to your philosophy, which is no easy feat, especially in an age where there's so much news flow around every 5 minutes. But that's what we aim to do, and with that, I will touch on this. I'm not going to go through it, but a lot of people do ask us about our process. We've added some new slides. The marketing team's done a great job of trying to make this a little bit easy to understand from a visual perspective. This just shows you how we get down to, there's basically 400 stocks we can invest in, even though there's about 2,800 listed on the ASX, and it goes back to my point of being about there's 2,400 companies that just aren't investable. So it is quite a small universe, hence why we run quite a concentrated fund. Our ESG framework, we've tried to tighten this up again and make it a little bit more formal, and we'll continue to do a lot more work on this and hopefully give, I suppose, a little bit more reporting back to all of our shareholders on this, but we're paying a lot more attention to this and think this is very real. And I give the example that we invest in a contracting business. It's been around for 60 years. Third page of their presentation this year was we've hired our first 2 female senior project managers. This is for a family business where you would never have seen anything like that, and they did that on their own accord. It is happening, it is changing, and I think the way businesses react and function with their local communities, employers and things like that is becoming a much bigger issue that businesses do need to manage and tackle. And then finally, our number of shareholders, just I think in my view just shows that hopefully we continue to do a reasonable job of not only managing the portfolio, but obviously communicating what we're doing and why we're doing it. And pleasingly, we've been able to grow the number of shareholders organically across 3 of the LICs. We continue to do that, most of the time, month on month. And finally, that's how you can stay in touch with us, if you so wish. Thank you very much for your support. We do appreciate it, and thanks again for coming. Hopefully we will be in the same room next time in 6 months' time. So thanks again for coming and enjoy the rest of your day.